Hi, I'm David Busch, the Co-Chief Investment Officer at Trajan Wealth. I had the opportunity while I was in New York to sit down with Diane King and the Schwab Morning Movers. Please check out this video for my insights on the economy and the markets. And don't forget to like and subscribe.
Joining me now to discuss the market reaction to yesterday's FOMC meeting and beyond, I'm joined by David Busch, Co-Chief Investment Officer at Trajan Wealth. David, thank you so much for joining us here at the Stock Exchange.
Thank you, Diane. It's glad to be here in person.
It's good to see you. All right, so the Fed did what we expected it to do. It cut by 25 basis points. One thing that surprised me was there was really only one outlier in terms of a jumbo cut, right?
That's right.
And so, we know the dots are anonymous, but the one we can pretty much guess who that is. Was that surprising to you at all?
It wasn't. I mean, I fully expected Mirren to dissent and call for that.
Well, not him, but Waller and Bowman.
That was surprising too, because essentially what they did is, the Fed coalesced around, they unified essentially, and that was a step to demonstrate independence, Fed independence.
Okay, so that was a step to demonstrate Fed independence. And in terms of the market reaction yesterday, it was a mixed reaction, but small caps, right? There was a tail there, and there's been this question about, when will small caps break out, right? And will they continue that momentum, and will they reach the records that we've seen the S&P 500, the NASDAQ, even the Dow participate in? And now, when we look at where markets are this morning, it seems like all systems go. What's your take?
Yeah, I totally agree with that. And what's interesting is typically speaking, when rates fall, it should benefit small cap and mid cap and large cap growth, and specifically large cap tech. And so I would have expected, small caps to outperform given the rate cut.
Do you think the market is reading this right, especially when we look at where the dots lie, right? We know it's anonymous. 9 of the group see 2 more cuts, 2 see 1 more, 6 see none, 1 sees a hike. That's a surprise to me.
Yes.
Was that a surprise to you at all?
It was a surprise. But when you look at their summary of economic projections, they're forecasting they're forecasting GDP growth, they're forecasting inflation to remain persistent through the end of this year and even into next year, and unemployment to inch up higher, but then ultimately fall back down. So we're sort of in this Goldilocks zone. And so it was interesting to me that one person was calling for a rate hike, just given all the evidence that we have. But at the end of the day, I think that inflation pressures will continue to subside. But investors need to be prepared for what I call inflation volatility.
Inflation volatility. And where do you expect to see that? And when do you expect to see that?
Yeah, so we know that inflation hasn't been totally vanquished. We know that it's still persistent in the market. What can happen is the impacts of the tariffs, or if we start to see inflation rising, it could be anything, supply chain disruptions, tariffs, and so on. And so what that'll cause is volatility both in the bond and the stock market. And so what I have been advising clients to do is to invest on the fixed income side in the 3 to 5 year part of the curve, but maintain an allocation to tips, because that can help offset and risk, manage some of that risk associated with inflation.
Do you expect to see any volatility pick up, especially when we head towards the holidays? Because what I'm thinking about is, for instance, we have this pause with China, right? We get a lot of stuff from China, probably everything that we're wearing, if we look at the label, says made in China. And so the pause takes us through November. We know that Besant and crew went to Europe which is the place where all these negotiations have been happening, different places in Europe. But we haven't heard anything, and the president is set to have a call, as we know, from what's been posted on Truth Social with China President Xi on Friday. Where do you think, do we think that, are you preparing for just another extension of the truce, if you will, or will we actually get a deal?
It would be great if we could get a deal,
right?
Because you're exactly right. A lot of our goods that we buy come from China. They're manufactured in China, and tariffs that we add to those goods flows through to the consumer, and the consumer is already stretched thin. Higher interest rates, credit card debt, auto loan debt, personal loan debt has been rising, and delinquencies and defaults have started to pick up. So we know consumers are stretched. we need prices to come down and rates to come down, to help manage some of that risk associated with consumers just pulling back.
And then one of the things that, the Fed talked about the job market, right? And or Fed Chair Jerome Powell talked about the job market. And it feels like there's, kind of constraint on both sides, if you will, right? We're losing some labor. And at the same time, some companies are just cutting back in general.
That's right.
So it feels like there's this balancing act. What are you telling clients about how to invest and where to invest when you think about all the, kind of just disruptions and things that we don't have full clarity on?
Yeah, I think really what'll happen is we're seeing a broadening of the market. Obviously tech has been the leader for the last several years. But now that if we have a positively sloping curve, it should benefit financials, some consumer discretionary materials, and so on. So I'm leaning more defensive because valuations for tech companies is really high. So I still am a firm believer in tech as the wave of the future.
Well, look at Intel and Nvidia today.
That was amazing.
Yeah,
and you saw that pop in price. So I think just stay balanced but also look at other sectors outside of just big tech, as a defensive play.
Yeah, it's interesting that you say that. And then when you say as a defensive play, are you talking like utilities, for instance?
Value, dividend payers, and just making sure that there's an allocation of both growth and value.
Dividend players, especially so you can have a little extra pocket change.
That's right. That's right. Exactly.
All right, David, we'll leave our conversation there for today. Appreciate your time.
Thank you, Diane.
Thank you.
Appreciate you.
That's David Busch, Co-Chief Investment Officer, Trajan Wealth. Our thanks to David for coming.